Well, good morning and welcome to Financial Accounting. And as we look at our calendar, and I probably need to turn on the projector in the classroom. As we look at our calendar, you can see because we finished Chapter 7 on Monday, the Chapter 7 problem should be submitted for grading by the end of the day today. And we'll be starting Chapter 8 today. So the Chapter 8 pre-quiz should also be submitted by the end of the day. Remember, on Friday, we are starting with the drop-in review sessions. Anyone is welcome to attend. They are totally optional. I plan to let you lead the way on what those sessions are. So whoever comes to those sessions can tell me, here's what I'd like to talk about today. We'll try to meet everybody's needs in those sessions. If you can't make the session, but you're interested in what we're talking about, I do plan to record them. If there's anything from the exam, though, that people want to go over in that session, I will not be recording that part, just so you know. So if you do want to hear something specific about the exam, if there's a question you want to go over, and we can do it in that session, as long as it's not recorded, or you can set up another time with me privately or send me an email, and it might even be something I can help you through in an email, if that's what works for you. So this Friday's session will be 11:15 to 12:15. For next week, I would be happy to consider changing the day or the time. I'm happy to schedule those frequently, even more than once a week, if that would be beneficial. But I need to hear from people, yes, I'd like to attend, and here's when I could come. Friday mornings don't work for me, but here's when I could do. As always, you're welcome to set up one-on-one appointments with me as well. And there's also a tutor available for this class, so feel free to set that up. Both of these, the drop-in session and time with the tutor, can be scheduled directly through the course in Starfish. And if you just want to schedule one-on-one time with me, that can also be done under your Success Network in Starfish. Any questions about that? At this point, I only have one person signed up for Friday's session, so we'll be talking about what that one person wants to talk about. But if there's anyone else who plans to sign up, you are welcome to do that. And if there's something specific you want to talk about, you can let me know when you sign up. Send me an email. Could we talk about this? Could we go over the Chapter 7 problem or whatever? All right. We did finish up Chapter 7 on Monday. Is there anything anyone wants to talk about from Chapter 7? All right. Well, if there aren't any questions, then we will just get started with our new chapter. So our next chapter is called Receivables. So today we will be talking about accounts receivable, and on Monday we will be talking about notes receivable. We'll see, we may not get through all of the accounts receivable information today, but definitely notes receivable we will be for Monday. You can see we have 8 learning objectives for this chapter. And we will be working through each of those with our exercises. As usual, learning objective 8, we will talk about using receivable analysis to analyze the liquidity of our company, and most of the calculations related to that we will hold off until chapter 14, where the focus is on financial statement analysis. So let's talk about receivables. We heard that word receivable first in chapter. We heard the word receivable first in chapter 1. And so we know what a receivable is. A receivable is an asset for us. It means that someone outside the company owes us something, usually money, and that we will collect on that later. So that is what makes it an asset for us. The receivables that we have focused on mainly since chapter 1 is accounts receivable, where we sell to a customer on credit. The customer agrees to pay later. We've already talked about in chapter 5 the concept of payment terms. So when is the bill due? Do we offer a discount if they pay early? And so we saw terms like 1%, 10, net 30, or just net 60, things like that. In this chapter, we'll also be talking, as I said, next Monday about notes receivable. And a note receivable differs from account receivable because a note receivable is typically for a longer period of time, and it also includes a payment for interest. So in this chapter, we'll be learning about how to calculate simple interest on those notes receivable as well. Excuse me. Most of the time, virtually all of the time, our accounts receivable are going to be short-term or current assets, because it would be very unusual to have an account receivable that was due more than 1 year from the date the credit sale or the charge is made. And so our accounts receivable will always be classified as a current asset on the balance sheet. Notes receivable, on the other hand, could have any term that is agreed to by the borrower and the lender. So a note receivable could also be a long-term asset, and we would generally then call that an investment. So whether a note receivable is current or long-term depends on when is it due. And if it's due originally 2 years from the date the note is made or signed, then it is a long-term investment. But as time passes and that due date gets closer and closer, once it gets to being due within 1 year, it becomes a current asset for us. We'll talk about this more on Monday when we talk about notes receivable and calculating interest, but it's not uncommon for notes, and I think I used the term in the last chapter on Monday, promissory note. So a note may result from something that's originally an account receivable. So a customer buys from us on credit, and then as the due date approaches, whether it's 15 or 30 days or whatever, as that due date approaches on the account receivable, the customer realizes that he or she is not going to be able to pay on time. And so they ask for an extension of time to pay. And usually then it can be, if there's an agreement, it can be converted into a note where the seller is basically saying, sure, we'll give you more time to pay. However, we want to be compensated for that because you're basically holding on to our money for a longer period of time. There's an opportunity cost associated with that. So yes, we'll give you another 6 months until you have to pay, but we want to charge you interest on that as well. And so that account receivable would be converted into a note receivable. There's really an incentive for the seller to allow that, because what's the alternative? If the customer is saying, we can't pay when it's due, of course you would want to give them an opportunity to be able to pay, as opposed to writing off that account or sending them to collection, where you might have a less likelihood of actually ever collecting on that debt. You can see at the top of this slide a couple other receivables that we might see: interest receivable, tax receivable, receivables from employees who maybe have, I don't know, bought some stuff from the company store or borrowed money from the company. That could happen. Of course, though, the receivables from officers and employees are generally going to be a smaller amount and for a shorter period of time, less likely to occur. Okay. We've heard, I'm going to write this on the screen here. Starting in chapter 3, we have talked about the matching principle. And just to remind you, because I haven't said it in maybe a couple of weeks, the matching principle is the foundation, is the reason, the explanation for why we do many of the things that we do to conform with GAAP, generally accepted accounting principles. And the matching principle says basically, we record revenues when they are earned. According to that test, do we have an agreement? Do we have a price? Has the product or service been delivered? And do we have reasonable assurance of collectability? So if all of those steps are met, all of those requirements are met, then we record the revenues in that period where the last one of those 4 steps is satisfied. And once we record those revenues, we want to match against the revenues the expenses that helped generate them. So we want to record revenues in the period they're earned and then match the expenses that go with those revenues. So what you see on this slide is the explanation for why we have to use what's known as the allowance method for uncollectible accounts. So because of the matching principle, GAAP requires, generally accepted accounting principles, those are US principles. US GAAP requires that we use an allowance method for estimating uncollectible accounts. So with that in mind, let's talk about what that even means. When we sell to someone on credit, we accept the risk that some of our customers may not be willing and or able to pay when that comes due. If we make the decision as a company, we're not going to sell to people on credit. We're only going to sell, we're only going to engage in cash sales. And some companies do that, right? Some companies don't extend credit. I need to remind you, we're not talking about accepting bank-issued credit cards. We're not talking about allowing customers to use Visa or MasterCard. That's a whole separate issue. But when we say on credit, we mean that the customer owes the seller. So they have an account directly with the seller with the agreement that we'll pay you later. As soon as the seller decides, yes, we are going to allow some customers to buy from us on credit, we recognize that there is a risk that some of our customers will not be able to or be willing to pay us when the bill comes due. So how does this fit in with the matching principle? Well, the matching principle says you record revenues when you've earned them and the expenses that go against those revenues in that period. Well, when we make the credit sale, we're recording the revenues. But do we know in the period, usually in the month, do we know in the month that that sale took place that the customer is not eventually going to pay us? No. Remember, the 4th step of recording revenues, the 4th step of the test is reasonable assurance of collectability. What that means is if we believe the customer might not pay, if we have reason to believe the customer might not pay, we're not recording the revenues in the first place. There are business reasons we might still sell to someone even if we're concerned that they may not be able to pay their bill. And I can give you an example of that in just a moment. But by definition, if the customer isn't expected to be able to pay their bill, we're not recording the revenues in the first place. So we're only talking about here the customers that we think, we expect will pay their bill, which will be the vast majority of our credit customers. As soon as we take that risk though, by extending credit to some or all of our customers, we have to recognize the cost or the expense of that risk in the same period that we record the revenues, because the matching principle says we have to do it that way. And it makes sense if we're trying to let people know, looking at our financial statements, we're trying to let them know here's what's happening in our business, then of course it's important that we have the revenues and the expenses that go together displayed on the same financial statement, on the same income statement. So the allowance method is required under GAAP, and that's what we're going to be talking about in this first part of the chapter, is how do we use the allowance method. We'll be looking at two different ways of using the allowance method to estimate, at the time we make the sale, estimate some dollar amount that may not be collectible. We don't know which customers won't pay us. Again, by definition, if we know ABC company's not going to pay, we can't record the revenues in the first place. Or if we have reason to believe they won't pay, we can't record the revenues in the first place. So we don't know who's not going to pay, but we need to estimate upfront how much we might not collect. And hopefully you can see the difference between those two. We don't know who's not going to pay, but we need to estimate upfront how much in total of all the amounts that are owed to us, how much do we think we will not be able to collect? And it is all based on the matching principle. Just as an aside, and I'm not going to spend a lot of time talking about this, but some companies are not willing to take the risk that their customers won't pay. And so there are ways that they can mitigate or lessen that risk or totally eliminate the risk. One is by only taking cash sales. So we don't have to worry about a customer paying if we make them pay at the time that they make the purchase. So that's one way to get around it. Another way is by accepting credit cards. And we saw this in chapter 5 when we were looking at purchases and sales transactions. We saw what that would look like if we accept credit cards. There is a meaning of Visa or MasterCard or something like that, that we are paying a fee to the credit card companies for the privilege of accepting credit cards. And that fee is usually, as I told you in chapter 5, between 2 and 6% of the total sales. We recognize that we're willing to pay that additional expense to be able to accept credit cards. A couple reasons we might want to do that. One, if we accept credit cards, our customers don't owe us, they owe the bank that issued that credit card. And so we're reducing our exposure or our risk, and paying that cost, that credit card expense is worth it to us. Why do we accept credit cards? Why don't we just tell people we have to pay in cash? Again, some companies don't accept credit cards because they don't want to incur that extra expense. But the reason that places do accept credit cards is because they know, statistically speaking, that if they accept credit cards, they will have more sales because people will buy from them because they accept credit cards, and that the dollar amount, the average sale will go up when we accept credit cards. So by accepting bank-issued credit cards such as Visa or MasterCard, we shift the risk of collection to those credit card companies, to the companies, the banks that issued those credit cards, in exchange for a slightly lower profit margin because we have to pay that extra fee we would not need to pay. There are a couple places in this book, and you've heard me say before, I've only been using this textbook for a couple years. The first 15 years or so that I was teaching accounting, I used a totally different book, different author and everything, multiple versions of that older textbook, different textbook. There are a couple places in this book, you've already heard me say that they use terminology that I don't particularly like, that I think there are better terms. The one that you've heard me say already many times is they say profit margin where gross profit rather than gross margin. And I would prefer that they use the term gross margin. That's the more commonly accepted phrase rather than gross profit. Gross profit is normally reserved when we're talking about just one single product, not an entire company's income statement. Here's another example of where I just don't like the term that they use. This book tends to use the term bad debt expense. And I don't know, for some reason that to me just sounds really harsh, and I prefer the term uncollectible accounts. The three terms that you see here in the second bullet point are all acceptable. They all mean the same thing. And I do like you to be comfortable with hearing different terms for the same, with the same meaning, because in the real world, there's no telling what company, a company that you might be dealing with, working for, might use any one of these terms. And so I do like you to be familiar with all of them. But this book defaults to bad debt expense. I will default to uncollectible accounts expense because that's my preferred term. Okay. So any questions before I keep going? Oops. So as I said, the US GAAP requires that we use an allowance method so that on our income statement, we're matching the revenues for that period with all of the expenses that go to those revenues. What that means is we have to estimate an amount that our customers in total may not pay us. So how do we know if a customer is not going to pay? Well, you can see on the screen some examples of that. When as soon as a receivable goes past due, we know that our risk is going up. The longer past due an account is, the less likely it is that we will collect on that account. If a customer files for bankruptcy, we may be informed by that bankruptcy judge that our debt is being eliminated through that bankruptcy. If the customer goes out of business or is unable to be located, isn't responding to our attempts to collect, we know we might be facing a problem. But all of these things that you see on the screen are signals that we receive in the future, not in the same month that we record the sale. So the matching principle, again, says we don't know this in advance. We don't know who's not going to pay, but we need to come up with a reasonable estimate of how much we might not collect long before these things start to happen. Excuse me. On this slide, you can see two different methods of accounting for uncollectible accounts. The first one you see there, direct write-off method, is not acceptable under GAAP. It is used for small businesses that aren't subject to GAAP, and it is used by companies that may not have a lot of receivables, so they may not be estimating upfront, or it also is used for tax purposes. So as you've heard me say in other circumstances, sometimes tax accounting and financial accounting are very different, and this is one of those areas. So we will use the allowance method as required for our financial accounting statements, but for tax purposes, we don't get to deduct the expense of uncollectible accounts until we actually write off an account, which is going to be at some point in the future. It may be a couple years even after the sale takes place. So let's go to our exercises there. So I'll give you a moment in case you don't have the Chapter 8 exercises open yet, but let's go to our exercises. We understand now, you should understand at this point, that in the same period that companies are reporting sales or revenues, they're going to have to estimate some amount that will be uncollectible and recognize that expense in the same period. So looking at our first exercise. MGM Resorts International owns and operates hotels and casinos, including the MGM Grand and the Bellagio in Las Vegas, Nevada. As of a recent year, MGM reported accounts receivable of $570,348,000 and an allowance for doubtful accounts or uncollectible accounts of $89,789,000. So let me stop there for a moment and we'll look at letter A. So MGM is owed, just rounding off here, MGM is owed $570 million, but they think of that $570 million they're owed, about $90 million of it they will not collect. And we're asked in letter A to compute the percentage of the allowance for MGM. So what percentage of the total accounts receivable is this allowance? So we take the allowance number and we divide by the total accounts receivable. And it asks us to round our percentage to one decimal place. So I got 15.7. Everybody agree with that? So at the end of the year, MGM believes that about 16% of the amount that's owed to it will not be collectible. And so this is what you would see on their accounts, excuse me, on their balance sheet. We already noted that accounts receivable will be a current asset. So you're going to see this on their balance sheet. And this is what you would most likely see on MGM's balance sheet. Accounts receivable net. And let me just do a quick math here. So on MGM's balance sheet, this is what you would see in their current assets. The net accounts receivable, that is the gross or total, whoops, sorry. That is the total accounts receivable minus the allowance. Net accounts receivable. This is the amount that the company believes is collectible of the total that's owed to them. So looking at this on their balance sheet, you cannot tell how much in total they're owed or how much in total dollars the allowance is. But if you look at the notes to the financial statements, you should find a note. I mean, normally in the notes to the financial statements, it's the very first note that deals with significant accounting policies. Once or twice I've seen it maybe as the second note, but almost all the time it's the very first note. So if you go to their annual report, you look at find their actual financial statements, which is going to be toward the end of the report. And then immediately following the final financial statement, the notes, the explanation information, the narrative starts. And almost always that first note will be the significant accounting policies. And one of them will deal with accounts receivable. And they will tell you, here's how much our allowance, here's how much we've set aside, recognizing that some of our credit customers may not pay. So if you see on their balance sheet that it says accounts receivable net, you know that they have an allowance. Otherwise, there would be nothing to net from it, nothing to subtract from the total that's due. Does that make sense to everybody? So on their balance sheet, they're going to show only the part that they think is collectible. That's the net amount. But in the notes to the financial statements, you should find additional explanation of what's included there, what the allowance is. So what I would like you to do now on your own is do that same calculation. In the next sentence, it tells us, as of a recent year, Johnson & Johnson reported accounts receivable of $11 billion, 11 billion, 2 million, sorry, 11 billion. Yeah, that's what I meant. 11 billion, $2 million and allowance of 268 million. So their receivables are much, much higher than MGM's. But their allowance is not that much higher. So go ahead and find the percentage that that allowance is of the total. I got 2.4%. Is that what everyone else got? Okay. And so on their balance sheet, they would be reporting about 10,700,000,000-ish in net accounts receivable. So what do we think about this? Why is MGM's percentage 15.7 when Johnson & Johnson's percentage is only 2.4%? Just read through the answers we have here. I will point out that in the possible answers, we have combinations. So it could be one of the four, or it could be these combinations of two of the four answers. So do we think that casino operators historically lose money on their operations? Do we think that's true? No, I would say probably not. Casino operators generally are not losing money. Do casino operators have larger accounts receivable? Is that true? Not in this case. MGM's receivables are only, how much was it? Like 500 million or something. And Johnson & Johnson's are 11 billion. So that one's not true either based on the information we have. So let's look at C and D. So we know the answer is going to be C or D or both. Individuals who may have adequate creditworthiness often overextend themselves and lose more than they can afford if they get caught up in the excitement of gambling. That sounds like it could be true. And letter D, casino operations experience greater bad debt risk because it is difficult to control the creditworthiness of customers entering the casino. That certainly could be true. Johnson & Johnson is only selling to wholesalers. Right? They're not selling to the general public walking in off the street. They're certainly not allowing them to extend credit. Now, I'm not suggesting these are not true numbers, but as far as letter D goes, and I would suggest the answer is probably C and D, as opposed to one or the other. But casinos do have the option of not extending credit to any customers, or making their customers pass a credit screening before they extend them credit. So they could decide, we're going to extend you credit and not you credit. They could require some kind of a pre-approval for credit. And I have no idea if they do or not. I'm not a gambler myself. So, but that certainly could happen. It's possible that they just don't do that. Why would they not do that? Because they've decided to accept the risk, in this case, a much higher risk than what Johnson & Johnson is facing. They decide to accept the risk that some of these customers that we're extending credit may not pay, because they know if they are too tight on their credit policy, they're going to lose sales, right? They're going to lose revenue. So they've made the decision that we're going to extend credit to, maybe it's everybody who comes in the door. I don't know. Maybe there's some threshold. I don't know the answer to that, but they have made a deliberate, a conscious business decision about which customers will get credit. And it may be that their credit policy is looser than Johnson & Johnson's because they're willing to take that risk because it bumps up their sales and bumps up their profitability. Make sense? So it's a business decision. Some businesses are going to decide not to extend credit at all. Some businesses are going to decide that we'll extend credit to anyone who asks. If you look at some car dealerships, and I don't mean like a Ford dealership, but a small, usually used car dealerships, it's not uncommon to see signs out front that say buy here, pay here, and we extend credit to anyone, or guaranteed financing, or something like that. You've probably seen those signs, and if you never have noticed them, I would ask you to just take a look as you're driving down the street at small used car lots. It's not uncommon that they have signs out that say something like that. They have made a conscious decision, a business decision, that we are going to lend to people who might be at higher risk of not paying. And how do they compensate for that? They charge a higher interest rate. So that is a decision that's being made by that company. It's worth the extra risk. We're going to get a higher rate of interest, and we'll get more reward. We want to be compensated for taking that risk, because some people who are not creditworthy still need a car, and we're going to take a risk that they will pay us, even if they don't have a great credit history. Make sense? Okay. We go back to our, skip that. Sorry, I'm just trying to find the next slide that I wanted. I guess that is. Let me go to this slide. This will be a good place for us to talk about. Oops, there we go. Okay, so I'm skipping the part about the direct write-off, because a direct write-off, as I already explained, is not acceptable under GAAP. And so you are not responsible for knowing how to do that. But I will just say a direct charge-off or a direct write-off means when we recognize that the customer actually won't pay, which is going to be most of the time, sometime, some point in the future, whether it's months or years down the road, only at that point do we record the expense or the cost of that write-off. So at the time that the account is recognized to be uncollectible, only at that point do we record the expense. As I said, small businesses that are not subject to GAAP because they're not publicly traded are likely to use that method. It's also the method that's used for tax purposes. But it's not what we are going to be doing in this class, because it is not acceptable for publicly traded companies. Those publicly traded companies are going to do what you see here on the screen. At the time the revenue is recorded, we are going to estimate how much is not going to be collectible. And we set aside, as this image on the left is showing, we set aside some value. Now, I do not want you to think that we actually take cash, like is being shown here, and put it in some separate bank account. That's not what happens. But on our balance sheet, we're going to set aside some value in this allowance account. The allowance account, and you can see here they're calling it allowance for doubtful accounts. I like to call it allowance for uncollectible accounts, but those are both acceptable terms. Allowance for bad debt. It used to be called the warrant for bad debt way back when. Warrant for bad debt, but we don't generally call it. I haven't heard that term in practice in years and years. So this allowance for doubtful accounts is what's known as a contra asset account. We've seen a contra asset account in another context as well. Anyone know where we've heard that term before? What other account that we have used starting in chapter 3 is also a contra asset account? Anyone remember?
For depreciation.
Depreciation, good. So accumulated depreciation is a contra asset. Contra means against. So it means it goes against the asset. It has a normal credit balance because it's going against the asset, which has a debit balance. So it has a normal credit balance. On our balance sheet, if we were to see all of the detail, you would see that the allowance goes right along with the accounts receivable. It'll be the very next account listed on the chart of accounts. The accounts receivable is going to have a debit balance. That's the gross or the total amount that's due to us. And then immediately following it, we have this credit balance account or normal credit balance account that nets against that. And I already explained to you that on the balance sheet that's published, what you're going to see is just the net amount, which is the amount of what's due to us that we believe is collectible. We've already subtracted that allowance. So again, at the same time that we record the revenues in that same period, at the end of the period when we're doing our adjusting entries, we're going to do an adjusting entry for the receivables. We set aside this allowance. So the entry is going to include a debit to uncollectible accounts expense that's going to show up on the income statement to match against those revenues. And the credit is going to be to this allowance. We're setting aside that value so that when we, in the future, sometime down the road, when we recognize that a particular account needs to be written off, we write it off to the allowance. Rather than recording expense at the time that the account is written off, which violates the matching principle, we're going to debit the allowance account and reduce that allowance. And the credit is to accounts receivable. And we're going to see that in one of our exercises coming up here, how we actually write off an account. So we now have the basics for what's going to happen here. In the same period we record the revenues, we're going to set aside some value to represent the amount we think is not collectible. So the question that maybe is coming to mind right now is, but how much do we set aside? How do we know the dollar amount of this entry? We've talked about what the entry will look like, a debit to uncollectible accounts expense and a credit to the allowance. And then when we write off an account, we're going to debit the allowance and credit accounts receivable. We know the mechanics of how it works, but the next question is, but how much? What dollar amount? How do we know how much to set aside when we don't know who's not going to pay? We're going to be covering two different ways of estimating how much we won't be able to collect. Let me get this off so I can go to the next page. And so there's two different ways, let me skip through this, two different ways that we're going to estimate that. And let's just go to our next exercise and talk about the first one of those ways. This a little bigger. So two different ways we can estimate our uncollectible accounts. The first one focuses on the balance sheet, and that's what we're seeing here. On the balance sheet, we look at our receivables and estimate of how much is due to us, how much do we think is uncollectible. We do something that's called an aging analysis. We look at all the companies who owe us money. We look at when those invoices were due, and based on the age of those invoices, we determine a value, a dollar amount that we think is going to be uncollectible. What we're seeing here is a partial aging of the accounts receivable. We can see the subtotals across the bottom here. It appears that the accounts were listed in alphabetical order. They're not showing us all of them. And then we're told that these accounts, these companies were left off, and we need to add them in to our aging. And so the first thing we have to do is figure out for each one of these companies with an invoice due on this date, how far past due is it? And if it's not past due, we're just going to enter a 0. So we are looking at this as of July 31st. Now, I don't think we have yet in this class calculated due dates. So I want to just say, if you do not know how many days there are in a given month, don't guess. Look it up, find a calendar. I venture to say most of you have a calendar app right on your phone. So if you're unsure how many days there are in April, don't guess, because if you guess, you're going to get the answer to this wrong. And it will have nothing to do with whether you understand the accounting and everything to do with whether you know what a calendar includes. And I'm not kidding when I say that. If you're listening to me thinking, why is she even saying that? Who doesn't know how many days there are in a month? Trust me, some people don't. And that's fine, but know your limitations. If you don't know how many days there are in April, look it up. That way you'll be sure you get the answer right. So this invoice for Boyd Industries was due on April 7th. There are, in case you don't know, there are 30 days in April. Do you guys know the little ditty that people use their knuckles if you have a typical hand of 5 fingers? You guys know that trick? When I was a kid, you learned the song, 30 Days, Half September. Do you guys know that one? I'm not going to sing on the video. You would not thank me for that. But there's that little, poem, 30 days, half September, April, June, and November. All the rest have 31, February. I know it doesn't rhyme. I didn't write it. One of my students years ago taught me this thing with your knuckles. So if you can start on your pinky finger or on your index pointer finger, whatever's easier. But if you start on the knuckle and just go across your hand touching the knuckle and then the groove between your knuckles, when you're on a knuckle, it's 31 days. If you're in the groove, it's 30, except for February. And when you get to the end, you touch that one again to start coming back. And it works. And I wish I could remember who told me this, because I'd love to give that person credit, but it was several years ago, many years ago now. So just do it. Some of you probably already doing it. And I just can't see you because you're on Zoom with your cameras off. January, February, March, April, May, June, July, August, September, October, November, December. It works as long as you have 5 fingers. So do that if it helps. Look it up on a calendar if it helps. If you're confident that you know how many days there are in each month, that's fine too. So there are 30 days in April, and the invoice wasn't due until April 7th. So we don't start counting it as late until April 8th. So 30 minus 7, we don't count the first 7 days, we count the next 23 days. So that's 23 days in April that this invoice was past due. Then there are 31 days in May, 30 days in June, and 31 days in July. And so for Boyd Industries, that invoice was 115 days past due. You can see what the categories up here are. Not past due, 1 to 30, 31 to 60, 61 to 90, and over 90 days past due. Those are the categories this company decided to use. Another company might lump everything past 60 days into one category. Another company might have 91 to 120 and then an over 120 category. That is not critical. How many categories they choose to use depends on the company and the way they do business. If they never have invoices that go over, or almost never have invoices that go over 90 days past due, they don't need to add extra categories or extra aging categories beyond the over 90. Totally up to the individual company. Let me go back down here. So if this is July 31st that we're doing these calculations, you can see that Lockwood Companies isn't due until August, so we're going to put a 0 there. It's not yet past due. For Van Epps Company, it wasn't due until July 2nd. So the first 2 days of the month, we're not counting. There are 31 days in July, so 31 minus 2. The Van Epps Company invoice is 29 days past due. I would like you to try the Hodges and Kent Creek on your own. I'm going to pause the recording and let you do that and then restart the recording. Okay, so we now have the number of days past due that each one of those invoices is. I'm going to clear the calculations there. And what we're going to be doing next is finishing the aging of receivables schedule. So what you see in the top part is the same information that was given up here. I'm unsure why they give us boxes here. We do not need to put anything into those boxes because this part is already completed for us. And it tells us if an amount box does not require an entry, leave it blank. So the first 4 lines of this are the information that was given to us up at the top, but we are asked to fill in the information for those 5 companies that we just calculated. So we'll start with the total amount of their invoices. The balance of their invoices here is going to go in this first column. Going to refer to my printout here rather than scrolling back up and down. But this total column, the first column, is for the total amount that is due to us. Remember, the assumption was that these accounts were inadvertently omitted, accidentally left off. And so the company is owed more than the $1,050,000 we see here. And to find out the total, the gross amount of the receivables, we're going to start with the $1,050,000 and add those missing 5 invoices. So go ahead and do that. And so for this AR aging analysis, we know that Evers Industry is owed a total of $1,124,500, but we are trying to figure out when those invoices or when those amounts were due. So we've already calculated here how many days past due the invoice was. So for Boyd Industries, it was 115 days past due. So that's going to go out here in the over 90, because obviously 115 is over 90. For Hodges Company, it's 63 days past due. So that's going to go in the 61 to 90. Kent Creek was 53 days. So that's going to be in the 31 to 60. Lockwood is the one that was not yet due, so that's going to be in the first column here, not past due. Whoops, wrong line. And then finally, Van Epps was 29 days past due, so that's going to go in the 1 to 30 category. And then we simply need to add down each of these columns. And so now we have the completed aging schedule. We know when each one of these accounts was due. That's the first step. Now, if you're looking at this saying, what do you mean the first step? How much more can there possibly be? I will tell you that this part is not something in 2022 that needs to be done by hand. The computer, the accounting information system that you use is going to produce this schedule for us. Okay, so we are not doing this by hand. But the reason that I chose this exercise for our exercise set is so that you recognize what it is that the computer is doing for us. Check my work button. Any questions about preparing the aging? What it is that the aging shows us? So of the $1,124,500 that is due to Evers Industry, more than half of it, $607,400, isn't even due yet. So how worried are we about the invoices that aren't even due? Most of those, the customers are just going to pay us when the invoice is due, right? Most of those. We're not too worried about that. It's not even due yet. But the older these invoices get, by the time we get out here to these invoices, $66,000 total, that is more than 3 months past due, we're pretty worried about those because we've probably sent these people at least 3 bills, right? We've probably sent them a bill every month that each month is showing, hey, it's due. It was due last month. It was due 2 months ago. It was due 3 months ago. And the customers clearly are not paying us. So the older the invoices get, the more concerned we are that they're not going to pay. And the higher risk, the higher a percentage of those invoices we think we're not going to collect. Make sense? Okay. Doesn't mean none of those are going to be collectible, but we get more and more concerned. There's a higher and higher likelihood. The older that invoice is, the more likely it is that we're never going to collect that amount. So now we go to our next exercise, which you'll notice looks familiar. Evers Industry, and here's their balances. These are the amounts that we just calculated on the previous exercise. Here's where we apply the concept of the allowance. So we produce this aging. As I said, the computer actually would produce that for us in 99.9% of the time. We don't have to do that by hand. So the computer produces this printout for us that shows these totals, the total amount, our gross accounts receivable, and then the breakdown of when those invoices were due or will be due. As I said, as we were looking at the PowerPoint, I said, so we need to, the biggest challenge for us then is not how do we record this, because we've already talked about the entry to, the adjusting entry to record the allowance. And then we talked about what the entry would look like when we actually have to write off an account sometime down the road. But the challenge is to know the dollar amount. How much do we set aside? We know it's going to be an estimate. It has to be an estimate. We don't know in advance who's not going to pay. We don't know in advance exactly how much we're not going to collect. But GAAP, the matching principle, requires that we estimate. And this is one way of estimating by looking at what is owed to us, how old are these invoices, and this is the new line that's been added for this exercise that we did not see in the previous exercise. This is the percent of each one of those categories on the aging. This is the percent that we think is not going to be collectible. And you can see that that percentage increases the older those invoices are. So for these invoices that are more than 3 months past due, we estimate we won't collect 3/4, 75% of that. And where do these percentages come from? Nobody tells us that. Let me stop any concerns. For class, those will be provided to us, just like they are here. We, for class purposes, do not have to figure this out. But where do we come up with these percentages if we're the company? Well, it tells us right here, we have a history. We look at what's happened in the past and say, is that likely to continue? Are we likely to follow those same patterns? We assign these percentages or estimate these percentages based on what has happened in our company in the past and what do we know about current conditions? So in 2022, if you're working in an industry where the economy is harder hit, you might be looking at these percentages and saying, we might need to bump those up a little bit because our customers are struggling and there's a increased likelihood that they won't be able to pay. But again, these percentages are based on what's happened in the past and what do we see as current conditions on the ground. And we're going to estimate those percentages. They're not going to be perfect, but we're going to do the best we can with what we know, with the information we have at the time. So, Evers Industries has $607,400 worth of invoices that aren't even due yet. As I said, we're not very concerned about those. So we have estimated only 1% of those will be uncollectible. Because what's going to happen? Those invoices, some of them are going to get paid this month, and some then will move into this 1 to 30 days past due. In the month after that, a smaller number, we hope, still don't get paid and move into the 31 to 60, and so on. And so as invoices get paid, they drop off. As time passes and invoices don't get paid, they move into the older and older categories. So of this $607,400, we think that 1% of those eventually will need to be written off. What is 1% of 607,400? 6,074. So of this total, we estimate that eventually 6,074 of that will not be collectible. That amount will continue to move out and out and out as those invoices get older. For the invoices that are 1 to 30 days past due, and some customers just didn't pay last month when they were due, we're still not terribly concerned, and so we've estimated a little bit higher percentage, but still not a very big one. About 3% of those we think won't be collectible. 3% of 233,000 is $6,990. And we're going to apply those percentages, multiplying the total dollar amount of invoices in that category by the percentage we think is uncollectible, and continue across with our calculations. Until we get to that final category, we already pointed out, we think 3/4 or 75% of that amount will not ever be collected. So now back to this box that I left open. This is going to be the total amount that we think is not collectible. So we're going to add up the amounts from each one of those categories to get the total. And I got $106,106. So of the $1.1 million that is owed to Evers Industry right now, about $106,000 they think they're never going to collect from their customers. Okay, so now we know where the number comes from. If we're using this approach, as I said, this approach is focused on the balance sheet. We're looking at the receivables on the balance sheet. We are aging them and applying some knowledge of our history and the current economic climate to say, okay, of the total amount that's due to us, how much do we really think we're not going to be able to collect from our customers eventually? Is there any question about what we've done so far? Okay, so now what do we do with that? I'm just going to fast forward here to exercise 5. Okay. We'll come back to exercise. Never mind. We'll just do exercise 4 first. Sorry. So let's do exercise 4. I'm going to ask you to try this one on your own because it is a repetition, more emphasis on what we just did in the last exercise. So new company, Outlaw Bike Company. We're given similar information to what we had for Evers Industry. The dollar amounts, Outlaw Bike is owed a total of $1.4 million. This is the breakdown of the age of those invoices. And the company has already estimated for each one of those aging categories what percent won't be collectible. So go ahead and do as we did in the last exercise, find the total amounts for each category and then the total for all categories. I'm going to pause the recording and let you try that on your own. Once you get those answers, feel free to use the check my work button. And once you're ready, start the recording. Okay, so we now have for, what's the name of this company? Outlaw Bike Company. We have our total amount that is due to us, the gross accounts receivable, $1,401,800. And we have our estimate of how much of that total we think will not be collectible. And the hard part of this, the part that's hard to get right, is the part we don't have to do, which is what percentages to assign to each one of these categories. That's more of an art than a science. Excuse me. I feel like I might need to sneeze in a moment. That's more of an art than a science. It takes tinkering to do the best we can. Those percentages are likely to change over time as the economy changes, as our history changes. And so we're not going to be perfect. We do the best we can with the information we have at the time. And that's all we can do. So let's move on to our next exercise. And in our next exercise, bigger. In our next exercise, we will see, what do we do with this? Finding that number is really the hard part, but we somehow have to do an adjusting entry to get this information into our records. We've done the calculation of how do we get this into our records. So I've already talked to you, whoops, about what the entry would look like. They're using that term bad debt expense, which is fine, it's acceptable. I would use uncollectible accounts expense, but same thing. And it will affect our income statement in the same way. It will reduce our income based on our estimate. I'm going to put a T account up on the screen. I'll put it right here where there's a little bit of room. So the allowance, we said, the allowance for, I'm just going to call it UA, uncollectible accounts. We already said, if I were to label these as we were doing at the beginning of the semester. So we already said that this is a contra asset account, so it has a normal credit balance. Unlike accumulated depreciation, which always has a credit balance, this allowance account can actually have a debit balance. It's not the normal balance, but it can have a debit balance. And as we continue with our exercises, I will explain why it would end up, we'll see why it might end up with a debit balance. Normally, the balance is a credit, but it can have a debit balance. And we are told in this exercise that assume that the allowance had a debit balance of $51.40 at the end of the year. Okay, so right now it has a debit balance. What that would mean, and this doesn't make sense, okay, so what that would mean if this account truly had a debit balance that it kept, it would mean we thought our customers were going to overpay their accounts. Well, that doesn't make any sense. Of course, our customers aren't going to overpay what they owe us by $5,000. But that would be the interpretation of a debit balance in the allowance account, and that doesn't make sense. Now, we've just done the analysis of the aging, and we've said we think actually, it's not that our customers are going to overpay their accounts by $5,000, but instead, we think $63,400 of that amount that's due to us won't actually be collectible at all. I refer to that number as the target balance. The estimated uncollectible accounts is our target balance. In other words, it's how much we want to have in this allowance account. We've done the analysis of the aging. We've looked at all the invoices and when they're due and how far past due they are, if at all. We've assigned these percentages based on our history and our current knowledge of the situation. And we believe that $63,410 of these receivables may not be collectible. And so that's how much we want to have in this allowance account. Everyone following so far? Okay. So if we have $5,140 debit balance right now and we wanted to have a $63,410 credit balance, how much do we need to put into that account? We know we're going to credit the account. This entry is always going to include a credit to the allowance. So how much do we need to credit to this account right here? How much do we need to credit to this account to make the balance shift from a just rounding off, 5,000 debit balance to a $63,000 credit balance? How much do we need to put in there? Anyone have an answer for that? What does the credit to this account need to be to make the ending balance move from a 5,000 debit to a 63,000 credit balance?
68,000.
So did you say 50? Yeah, so you went the wrong way. The answer is 68, and then if we use the exact number, 68,550. If you want to think of it like this, one way to think of this might be the allowance is overdrawn. We took too much out of that account. And we'll see in I think it's our very next exercise. We'll see in an exercise, maybe not the next one, how that happens. But really what happened is we overdrew this account. So the first thing we have to do is put 5,140 back into the account because we took too much out in the first place. Then we have to put in another 63,000 to get it up to the $63,000 credit balance that we're looking for. And so the adjusting entry, remember, the entry we make is for the change we want to see. We want this account to shift from the debit to the credit side. Sometimes I think it's helpful to think of it like a number line too. So the debit side is in number line world, it's on the negative side, and the credit side is on the positive side. So we need to move it 5,140 back to 0, and then another 63,410 to the right to get it to where we want it to be. So in the AR aging approach that we're covering here, we do the analysis of the aging, we come up with our target balance, then we look at what's in the allowance now, and it won't always be a debit balance. So it is critical that they tell us whether that balance in the allowance is a debit or a credit, because it could be either. More often than not, we hope it's a credit balance. Should be a credit balance, but obviously it can be a debit balance. We find that target balance, then we look at what's in the allowance account and figure out what's the entry we need to make so that our ending balance is what we're targeting, what we said ought to be in there. Any questions at this point? Okay. We have about 10 minutes left, so let's go ahead to our next exercise. And I think I'm probably going to put some, maybe put some T accounts. Maybe not, maybe not. Let's just start with what we're given here. During its first year of operations, Max Plumbing Supply Company had sales of $6,740,000, and they wrote off $48,600 of accounts as uncollectible using the direct write-off method. So they recorded $48,600 of expense using the direct write-off method, and that reduced their net income. They were still left with net income of $712,500. If they hadn't written off any accounts, what would their income have been? If we get rid of that expense for the direct write-offs, their income would have been $761,100 without the write-offs. Without write-offs. Okay. Everyone okay with that? Makes sense so far? Okay. So Max Plumbing Supply Company may not be required to use the allowance method. If they're publicly traded, yes, they need to use it. If they're choosing to follow GAAP, then they want to use the allowance method. I would suggest that if they are sharing their information widely, if they're trying to get funding, for example, and maybe if they're trying to borrow money from a bank or other lending institution, they may want to use the allowance method if they have a lot of receivables, just to make sure that they are fairly portraying what's happening inside their company. So I told you toward the beginning of class that there are two different ways that we can estimate uncollectible accounts. And we've just seen in the last few exercises one of those ways, which is by looking at the aging on our balance sheet and assigning an amount that we think will be uncollectible, targeting what should be in that allowance. This exercise is the second way. This exercise uses what's known as the net sales approach or the income statement approach. So instead of looking at what's owed to us, we look at the income statement and we look specifically at our sales. And sometimes we might look at our credit sales. So this tells us that that Max Plumbing Supply had sales of $6,740,000, and that they estimate that 1% of those sales might be uncollectible. So we start with our sales, $6,740,000, and we multiply by the percent of those sales. And again, it could be a percent of credit sales that's given. Percent of sales that we think is uncollectible. So of the total sales, they estimate 1% of those might be uncollectible. 1% of 6,740,000 is 67,400. Well, during this year, Max wrote off 48,600. But what we're suggesting is, yeah, but we think eventually we'll have to write off even more. Rather than writing off only 48,600, because those are the write-offs we did in the first year, that there might be some amounts that are still owed to us that carried over into the next year, and we just haven't written them off yet. Because maybe the sale happened in December. Or maybe the customer, the invoice was due in November, but the customer said, we're going to pay, we just can't pay yet. We need a little bit more time, or something like that. So the question we're asked here is, if they had used the allowance method, what would their income have been? So we started with the income that was given, $712,500, which included those write-offs of 48,600. So I added those back and said, without any write-offs at all, our income would have been 761,100. But if we use the allowance method as we are required to for GAAP, the expense we recognized would actually have been 67,400, not just 48,600. So 761,100 minus 67,400 is 693,700. And that is the answer to this question, but I'm going to take it one step farther, as I like to do. Okay. So if Max had used the allowance method rather than the direct write-off method, their income would have been less. Does everyone see that? And the reason it would have been less is at this point, they've only recognized the expense of the accounts they've actually written off in their first year. They aren't taking into account that some of those accounts might be written off next year or possibly even the year after. Okay, so their expense would have been less. Any questions about that? Their expense would have been less when they use the direct write-off method because it's their first year of operations. Now, in the future, when they're writing off accounts from potentially last year and this year, those numbers might come closer into sync, closer into balance, because right now they're off by about $20,000 difference. In the future, we probably wouldn't see that big of a difference between the direct write-off method and the allowance method. Okay, any questions about that? Okay, so the last thing I want to do for today then is look at what this entry would have looked like. If we use this approach where we look at the income statement, we look at their sales and we estimate a percent of their sales or credit sales that wouldn't be collectible. This is what the entry, the adjusting entry would look like. We would still have the uncollectible accounts expense or bad debt expense or whatever we're calling it. That's still going to be the debit side. And the credit side is still going to be the allowance for uncollectible accounts. The dollar amount that we would use for the entry, so the accounts are the same, regardless of which method we use, the balance sheet approach where we use the AR aging or the income statement approach where we look at our sales. But here's the difference. The dollar amount that we use is based strictly on what our sales were this period. So we had calculated right here, we took our sales or our credit sales, if that's the way we choose to go, multiply by some percent, that percent is an estimate, and then we simply use that dollar amount for the entry. It's simpler than what we did in the previous exercises. It's a simpler approach. We didn't even look at the balance sheet. In this exercise, we are not told what the balance in the allowance account is or would be. We don't need to know that. We don't look at what's happened in the past, other than how it impacts this percent we think is uncollectible. We don't look at the allowance account to calculate this entry. And so it is a simpler approach. Is it better or worse? It is up to the company to decide which approach they want to use. I have my preference. If I owned a company and chose to use the allowance method or had to use the allowance method, I would use the balance sheet approach. Because it looks at what's happened in the past, it looks at what's in that account already and determines, okay, how much more do we need to put in there? But clearly, There are companies that choose to use the income statement approach. The difference is the balance sheet approach, the AR aging method, is focused on making sure that our net accounts receivable on the balance sheet is as close as possible to what we think is actually collectible. Where this approach, focused on the income statement, the net sales approach, is concerned about having the expense on the income statement be as accurate as possible for the current period. And there's not one of those approaches that's preferable to the other. It is really up to management to make that decision. Are we more concerned that the income statement accurately reflects expense from this period? Or are we more concerned about the balance sheet? And you can't have it both ways. So you really have to pick an approach that's going to work for your company, one that's better. Okay, we are out of time for today. I'm just going to get my green check mark in there. Anybody with questions before I stop the recording? All right, so thank you for being here. On Monday, we will finish up with this chapter, and most of our focus on Monday, not all of it, but most of it will be on notes receivable and interest calculations. If you are interested in participating next Friday, March 25th with the program review, please don't forget to send me a message and let me know that. All right.